Welcome to Beavers Wealth Management's July 2024 edition of Let's Talk Markets. Now, as I've said before, it's our goal to continue to grow Let's Talk Markets with the intent of educating and empowering the families and businesses we serve. So if you know anyone who may find this information valuable, please feel free to share it with them. We've got a great show for everyone joining us today, and as we typically do, this edition will focus on three key points. So first, we'll take a quick glance to the past. What happened this past July in the markets? Second, we're going to take a hard look to the present, a discussion revolving around the presidential elections. And then lastly, we're going to look to the future. What does the CrowdStrike outage say about our digitally interconnected world? So let's start off with a market synopsis, as we typically do. Now, one development we are noticing in the markets this month is the rotation that's starting to take place. So recently, U.S. small cap stocks, they have significantly outperformed U.S. large cap stocks over the past month. In July, it's no longer the Mag 7 leading the charge, which we've talked about in previous Let's Talk Markets. Instead, we're starting to see the smaller companies start to outperform. This was predictable given the current expectations for interest rates. And so if you look at a couple of the things that have occurred this past month, we've seen here that just last week, the S&P 500 and the NASDAQ, both were down. The NASDAQ down about 2% for the year. But if you actually look at the Dow, for example, positive almost 1%. The Russell 2000 up almost 3.5% last week. Looking at some of the other numbers, this is the first time also where all year every sector of the economy is positive. Even real estate's positive now. 10-year treasuries, still most of them slightly positive for the year, but the key here is unemployment rate is now a little over 4%. 4.1% is where we currently stand. So let's talk a little bit more about what happened in July and what we are seeing in the markets moving forward. So there's actually a saying, and it's buy the rumor, sell the news. And that typically guides investors to trade based on anticipated news and sell once the news becomes actual reality. And you've probably heard this many a times. But now in 2024, particularly within the technology sector, driven by the AI momentum, the strategy appears to have evolved to buy the rumor, buy the news, buy the dip, buy the rip, just buy, because it's going to go even higher, right? There's a name for this kind of behavior in markets, and it's called FOMO, fear of missing out. You need to be cautious because right now FOMO has been growing rapidly as AI and technology stocks continue to climb. Investors with minimal exposure to AI and technology stocks, they're driven by the fear of missing out on the rally. And those with significant gains in these areas, they fear selling too early and missing further increases. Ultimately, this behavior can create an aggressive cycle where more and more investors enter the market, pushing prices higher despite a lack of substantial earnings growth, which is important for the longevity and sustainability of the movement in the stock price. And then as soon as bad news starts to spread, then there's a risk of a swift and often severe sell-off. So I'll have an example for this, right? Let's take Tesla this month. At the beginning of the year, Tesla stock dropped almost 45%. Then it made an incredible recovery, turning things around, and it actually became positive on their delivery numbers that were favorable. With a favorable report with those deliveries, the markets got excited, right? And the stock swung back into positive territory for the year. After being down almost 45%, it then went positive. Many investors, driven by the fear of missing out or that FOMO, jumped in to ride the rally. However, last week, Tesla missed Wall Street expectations, causing the stock to plummet nearly 20% from its peak. The lesson here, don't chase returns. Historical trends suggest that chasing returns rarely ends well and is not a sustainable investment strategy. This FOMO-driven rally often peaks after most investors have missed out on the initial gains. So the most important mistake that FOMO traders make is they fail to keep a long-term perspective when they're making their investment decisions. You know what it's worth being fearful of, right? And so I got an expensive bill from the electric company this month. Man, I was shocked. All right, now let's take a look at this month's of Ryan's Market Fact. And his quote for this month is, "I like the odds." So when the S&P 500 has risen more than 15% by mid-year, which has actually occurred 20 times this past century, it's finished the year higher in 14 of those instances. So that actually implies a 70% probability that we end the year higher. Now, the 6 years where this did not occur, well, there were some significant historical events on why potentially it didn't end positive. 1929 and 1933, obviously that was the Great Depression. 1943, World War II. 1975, the oil crisis. 1983, the Federal Reserve's battle against double-digit inflation. And then 1987, like we all remember, Black Monday. Now, let's talk a little bit about what's happening in the present. What's going on right now and that we're all preparing for coming up in November. Now, I want to make it clear before I get into all this. I do not pick sides. I just stick with the facts of what's right in front of us. And so I want us to understand we focus on the data and the implication for the markets. And so with November fast approaching, elections are on everyone's minds. And recent events have added layers of complexity, right? I mean, my God, the last 2 weeks have been insane. We've seen an attempted assassination on a former president, the current president contracting COVID, and then subsequently dropping out of the race and being replaced by his vice president, and a general rise in market uncertainty as the election nears. In previous sessions of Let's Talk Markets, we've highlighted that this has been the best start to a presidential election year in history. A key reason for this really is the stability. It's been a lack of the uncertainty. We had a clear understanding of each candidate's track records, which provided the market with some type of predictability. From a market perspective, we knew what to expect, right, from both candidates. They had both been presidents before. Historically, election years are marked by higher volatility, and we are now beginning to see that expected increase in volatility. Now, our goal today is to examine elections from a market-driven, data-focused standpoint. Our goal is to share insights into how markets have responded to various elections over the years, offering a clearer picture of the historical context. Now, we've got a lot to go through, and we think you'll find the historical market reactions kind of surprising. And so I wanted to share 3 graphs here with us that I think will be very interesting as we go through it. The first one is the growth of $10,000 and the S&P 500 since 1949. There's 3 different lines on this graph. First is going to be that black line. That is if you stay fully invested through whether it's a Republican or a Democratic president. You can see that initial $10,000, that grows to over $3.5 million. Now, let's say you were just invested with a Republican president. So you were out of the market if, you saw a Democratic president and you were just invested during those periods of time. You can see that $10,000, well, it doesn't even register. It's not even up to the $500,000 mark. Now, let's say you did the other way. I'm only investing when there's a Democratic president. You can see that $10,000 is just under $500,000. Nowhere close to the $3.5 million if you just stayed invested, whether it was Republican or Democrat. This next graph is the S&P 500 index performance during a 4-year election cycle. There's a lot to cover on this page, and so what I wanted to show you is a couple of things as it relates to what each of those administrations would appear. And so a couple of points to notice as we go through here. 67 of the 92 years, which is 73% of the time, positive performance in the market. The average total return for a 4-year period of time, 46%. Now, when a Republican was in office, the average across that 4-year term was almost 8%. And when a Democrat was in office, it was about 14%. Now, some of that is skewed because of the Great Depression and the 2008 financial crisis for Republicans that brought down those numbers. But the idea is, once again, it doesn't matter from a Republican or Democratic standpoint on what you see during a period of time as it relates to markets, both positive. Next graph, the S&P 500 index returns in U.S. presidential election years. Like I said, a lot to cover on this page, and so we'll leave it up here for a few minutes in case you're interested to see this, but I wanted to highlight a few things. There have been 24 elections since the S&P 500 index. 24, that was kind of surprising to me. Would you believe me if I said 20 of the 24 elections, which is 83%, actually had positive performance? So 20 out of 24 presidents had a positive stock market performance under them. When a Democrat was in office, which we have right now, right? So I wanted to look at it and say, okay, with a Democrat currently in office, and a Democrat was either elected or re-elected, the total return for the year averaged 15%. When a Democratic was in office like we have right now, and a Republican was then elected, the total return for the year then averaged 12.9%. Once again, all election years, regardless of Republican or Democrat, you can see on average a little over 11.5%. So I thought these were interesting graphs to show because I know we can all get caught up with everything going on, especially over the next couple of months. And as it relates to markets, it's important for us to understand, regardless of what happens in November, we do see markets positive 20 out of 24 times. Now, what about the current state of the election? Currently, the Republican Party is unified, with President Donald Trump having announced J.D. Vance as his vice presidential candidate. Now, on the Democratic side, Joe Biden, as we know, recently dropped out of the race, and Kamala Harris is now set to be the nominee, though her vice presidential candidate is still undecided. Now, this uncertainty on the Democratic side is contributing to increased volatility in the markets. Now, I've seen one analogy being used to describe this move by the Democratic Party. It's like in hockey. When a team that's behind, they pull the goalie. This move slightly increases their chances of winning the game, but also slightly increases the chance that they will lose by more points, adding additional volatility. Now, what are some of the market predictions? What's the market seeing right now? Currently, the prediction markets give Donald Trump about a 70% chance of winning the race. Again, I'm not here to tell you what I want to see. We're here to tell you what we think we will see. The odds of a Republican sweep are roughly 55% today. Now, before the debate, the odds were about 40% that you'd see a Republican sweep. That rose to 60% after the debate. And then replacing Biden with Harris slightly reduced these odds back down to 55%. So if we end up with a Republican sweep, and I think that's the most likely outcome at this point, we are likely to see several changes in public policy. And so I want to talk a little bit about what we see in terms of potential changes. First one, Republicans will almost certainly extend and potentially deepen the tax cuts they enacted 7 years ago under Trump in 2017. And they may actually further reduce the corporate tax rate. Remember, it was cut from 35% to 21%, and it could possibly go as low as 15%. Second, there's been discussion of eliminating or reducing the tax on tips, likely aimed at benefiting the state of Nevada. If Republicans keep making this promise, they will probably fulfill it, at least partially, if they achieve a sweep. Third, we're also likely to see increased tariffs under President Trump. So he might attempt a 10% across the board tariff, despite some legal ambiguity about his ability to do so. But he would likely increase tariffs on Chinese goods to 60%. And he almost certainly has the power to do that unilaterally. Fourth, we would likely see a reduction in green energy subsidies. And fifth, while Republicans probably wouldn't have the votes to significantly reform Medicare or Social Security, they would likely have the votes and inclination to reform Medicaid, including large parts of Obamacare. So similar to welfare reform back in 1996, they'd likely block grant the programs to the states, allowing states to experiment with reforms and frankly, squeeze the program for budget savings in the years ahead. So bottom line, where are we right now? What does Beavers Wealth Management think? We must remember what's undeniably true. At the end of the day, markets are not moved by who wins the White House. The president doesn't control the markets. Now, they certainly can have influence, don't get me wrong. But what truly move markets long-term are two things: interest rates and corporate earnings. That's it. And so as we prepare our investment strategies for the next 4 years, we want our discussions to focus primarily on identifying which market areas are poised for growth and understanding the future investment landscape. And so that's why we offer our second opinion service. Anybody who's important to you is important to us. And that's why we welcome the opportunity to connect with anyone you believe that would benefit from a discussion with Beavers Wealth Management. All right. Now, on to our last point, which is always something about, what's happening in the future. And today we're going to talk a little bit about balancing innovation and stability. And this has to do everything with the CrowdStrike wake-up call from just a few weeks back. And so this past month, we highlighted some of the incredible innovations and growth that actually is happening right here in our home state of Texas. Now this month, we're keeping our focus on Texas and discussing a major event that had global implications. We're talking about the recent CrowdStrike software update that caused widespread internet disruptions. Now, for those of you who don't know, CrowdStrike is actually based here in Texas. And so we're unbiased here at Let's Talk Markets, right? We'll talk about the good and the bad in Texas. And so let's explore a little bit about what happened, how the markets reacted, and what this means for the future of cybersecurity. So what exactly happened with this incident? So this month, CrowdStrike, one of the leading cybersecurity firms, caused a major disruption. So a software update intended to enhance their Falcon platform inadvertently failed. Now, the update led to a global IT blackout affecting various sectors, including banking, healthcare, and aviation. Services were disrupted, planes were grounded, we all saw it, and many faced the dreaded blue screen of death on their computers. I hope you didn't see one. And what happened with all this, right? The update actually caused machines running Microsoft Windows operating system to crash, resulting in a cascade of outages across multiple industries. And the issue stemmed from the deep system access required by CrowdStrike's software to effectively scan and protect against cyber threats. And this deep integration, while usually it's very beneficial, it actually led to a severe conflict with Windows machines during this particular update. Now, kind of a side note, which is interesting, no Apple devices were affected by this, which may actually be one of the biggest takeaways from this event. Something to think about as Apple continues to try and compete with Microsoft in selling more devices to enterprises. Now, what about the market's response? Well, it wasn't pretty, right? The initial market reaction to the CrowdStrike incident was predictably negative, with the company's stock Their price dropped nearly 30% over the past month as investors processed the implications of these disruptions. Then it kind of created a contagion effect, right? The effects extended to other stocks, most notably Microsoft, which absorbed some of that negativity. And then you think about the impact on the S&P 500, right? Given that Microsoft is one of the top 3 largest stocks in the S&P 500, its stock price decline has significantly weighed on the index's performance this month. So what do we make of all of this? I think the thing to take away is the CrowdStrike incident. It serves as a stark reminder of the risks associated with our increasingly connected digital world. If a single software update has the power to disrupt banking, healthcare, and aviation sectors, grounding planes and causing widespread chaos, what does this say about the world that we live in? In today's world, everything is digitally connected. And while this brings incredible efficiencies and opportunities, it also exposes us to significant vulnerabilities. As we focus on the rapid growth of AI, we must be careful not to build a house of cards, for example, where our systems are so interconnected and dependent on each other that a single fault can lead to a cascade of failures like we saw. Sustainable growth and the digital age requires us to invest not just in innovation, but also in the resilience and stability of our infrastructure. Okay, in conclusion, what did we cover today? First of all, we recapped the past month of July, examining what's been happening in the markets over the course of the past 30 days. Then we kind of took a step back and we addressed what the markets currently are thinking about the election. And lastly, we looked ahead to the future and we discussed the importance of sustainable growth in this digital age. I have a feeling it won't be the last time we discuss this in future Let's Talk Markets. We truly appreciate you joining us today, and we are grateful for each and every one of you who've joined. If you enjoyed today's content, we'll have the replays of Let's Talk Markets posted on our new YouTube page, and the video podcast format is actually on Spotify. So please feel free to share with anyone who you know may find this valuable. Well, time flies like an arrow, but fruit flies like a banana. Enjoy the tail end of summer, and we will see you in September for our next edition of Let's Talk Markets. Oh yeah, don't forget, leave it to Beavers.